This is level 2 of the CFA program, the topic on equity valuation and the reading on equity valuation, applications and processes. I want to begin by reading you the very first question at the end of this reading that the Institute asks its candidates. And the question is, critique the following. And I want to make sure I get this correct. You ready for this? No equity investor needs to understand valuation models because real-time market prices for equity are easy to obtain online. Now, of course, the question reads, critique it, and that implies that the Institute doesn't want you to agree with that statement. If you agree with that statement, then you probably shouldn't listen to anything that I have to say for the rest of this slide deck, maybe even the rest of level 2. So I thought it was fascinating, and it's a great academic pedagogy to make certain that candidates are aware of the question. And really, this was the question. Why is this stuff important? So we're going to address that. No equity investor needs to understand valuation models. I think that's a fascinating critique. So let's look at these learning outcome statements. Notice that there's no calculate or compute in here. So we won't do any math, but we'll do lots of defining and lots of explaining. And notice that in almost each one, excuse me, in almost each one of those LOSs, there's the word value. So we're going to do lots and lots of understanding. What does that say? Understanding valuation models. Forget about the fact that real-time market prices for equity securities are available. Forget about that. That's market value. We need to concentrate on things like, boy, look at that first LOS, intrinsic value. All right, let's get started. All right, a brief recap. This is probably a recap from level 1, probably a recap from your undergraduate finance days. But here, valuation, of course, we're going to begin with the very beginning, and that's time value of money principles, in which we have some future value that is occurring. Maybe we expect it, maybe we've signed a contract, and we want to know what the present value is. So we need to figure out and compute present value of not only individual securities. This is what we're doing here in this reading because it's called equity valuation, right? But we're going to apply that to other things like the value of a privately held firm, or the value of a merger, or the value of a special purpose vehicle. What I always try to teach my students is that these valuation models are rooted in time value of money principles. That's why I spend 2 weeks at the beginning of my undergraduate finance class teaching them about time value of money. So what is this based on? Factors that determine the future returns of the asset. It can be comparison with similar assets, and that similarity can be in size or risk levels. And then, of course, what nobody really wants to talk about if you're an owner of a business is to consider threats of bankruptcy and then the liquidation process. But nevertheless, valuation is extremely important in liquidation. All right, the process of determining the present value of an asset. So we can do this in a handful of ways. We can collect variables that are related to future investment returns. We can collect data on similar types of assets. And that's probably the exam question that will show up here. Compare the absolute valuation to relative valuation methods. So remember that. And then over in the purple, there's our liquidation process again. Let's start with this concept of intrinsic value. I always use this kind of visualization for my students. Think of it as the core value. And I use the analogy of myself. You know, I'm standing in front of the classroom, and I wear the same clothes every day. I wear pretty much khakis and a button down, and I have a watch on. And I say to my students, look, if you looked at me superficially, you would say, oh, Jim doesn't really care much about clothes, et cetera, et cetera. He teaches class, so he's probably an okay guy. But then I say to them, but what is my core? What is my heart? What is my soul? What is the fundamental value of me, not just as a professor, but as a husband and a father and a friend and all those kinds of things? So I always think of market value as all the stuff that's around me. You know, I could put a hat on, I could do Rogaine, and I could have a big old head of hair. I could do all sorts of stuff. That's kind of market prices. And core value, intrinsic value, is what's really inside, right? So what does the reading tell us? This intrinsic value is determined through fundamental analysis while ignoring the market value of the asset. And of course, what we're going to do is we're going to say, all right, if we compute the intrinsic value of an asset and we think it's $100, remember, that's an estimated value. And then we look in the Wall Street Journal or we get on our phone and we see that the market price is $75. We're going to say, wait a minute, intrinsic value and market value are two different numbers. What's going on here? Let's figure out, is the market wrong or am I wrong? And so this is really the challenge of fundamental analysis. And of course, this is based on the efficient markets hypothesis. Remember, we go back to Eugene Fama thousands of years ago, maybe not thousands of years ago, but clearly in the 1960s and early 70s, where the efficient markets hypothesis suggested that, look, all these investors out there, they have identical information sets, they're rational, they process the information in the same manner, and they do it with completeness and accuracy and all that kind of good stuff. That means that intrinsic value is equal to market value. That's based on the efficient markets hypothesis. But we know that that's not always the case. So look at that first circle point. Intrinsic value is not always equal to market value. In fact, there are lots of technicians out there that would make the claim that it's hardly ever equal to market value. So what are we doing as good financial analysts, as good fundamental analysts, as good active investors? We're going to perform a valuation analysis so that we can put assets in our portfolio that are going to outperform. And of course, we need to make an adjustment for risk, whether we think risk is standard deviation, or we think risk is beta, or we think it's value at risk or exposure, or some other way that we can measure risk. And so the goal, of course, is to outperform some kind of a relevant benchmark. That might be the S&P 500. It might be the Wilshire 5000. It might be Jim's index, right? So we want to outperform on a, boy, look at that bolded down there in that last circle point, a positive risk-adjusted return, which is sometimes known as an alpha, which is sometimes known as an abnormal return. My econometrics professor in graduate school called that a prediction error. How's that for an academic term? All right, let's look at mispricing. And what do we know? We're going to talk at length about this in level 3 about the behavioral issues. So investors make cognitive errors and have emotional biases. And what that does is it moves market value away from its intrinsic value. And so what's important for us to understand here in level 2 is that there is this mispricing. So let's take a look at what the reading calls perceived mispricing. Perceived, that's an important qualifier in front of mispricing. So they believe, notice that there's a word there, believe that the intrinsic value differs from the market value. All right, so what are the sources of this? How about market error? This is true mispricing, where the difference between the market price and the actual or the true intrinsic value of the asset is they're not the same number. But there can also be a valuation error, and this is on us as the good candidate, as good financial analysts. This is the difference between the actual or the true intrinsic value and the estimated intrinsic value. And there's a good old little formula there. I'd be surprised if you have to use that on the exam from a mathematical standpoint, but I would know the difference between definitionally perceived mispricing, true mispricing, and then of course there's that valuation error. And boy, I don't want to throw this at you at this point because it's not part of the LOS, but that valuation error over there, that can include things like behavioral issues, like cognitive errors and emotional biases. Here's an LOS that wants us to distinguish between a going concern value and a liquidation value. And I learned this way back in one of my first classes in my undergraduate days, Introductory to Management. I had never heard of this concept of a going concern, and my professor said something like, executives have to make decisions in which they believe that the firm is going to be around a lot longer than you're going to be around. So continue operation in the immediate future. So the definition of going concerns: continue to sell its goods and services, will try to access sources of financing over on the right-hand side of the balance sheet. Remember, we did all that good stuff with Modigliani and Miller, and we arrived at an optimal capital structure. And then we're going to invest in positive net present value projects. That's the capital budgeting decision. So keep in mind, this going concern combines capital budgeting with capital structure, goal of the business, maximize the value to the owners. So a going concern value, look at the green diamond point, value of a company under the going concern assumption. That makes perfect sense, which is probably different than the liquidation value. And when you're liquidating, you're probably not doing it because things are going super well. You're doing it probably because nobody wants to buy your product lines. And so those assets then are going to be sold off individually. And so think about this. The net present value of a product line is based on its ability to generate cash flows over this going concern timeline. But a liquidation value is completely different. It's, all right, how much can we sell this asset, which, by the way, nobody wanted to buy its product lines at the end. How much can we sell this to somebody else who's probably going to look at it and say something like, okay, that asset stinks, but I can redesign it, I can retool it, and I can return it into a positive net present value for my business over here. All right, so going concern value is going to be greater than liquidation value because of things like managerial skills and the synergies between and among those assets. So that's probably a likely candidate for a good exam question. So look at those two inside diamond points at the bottom there. Value added from managerial skills, value added from asset synergy. All right, how about some definitions of value? Fair market value, value of an asset for a well-informed, willing buyer and seller. All right, that makes sense. So think of fair market value as two individuals who are meeting and trying to trade an asset, and they're both well informed, so they have an idea of the intrinsic value of that asset. And so if they meet in the middle somewhere, that's going to be a willing price. So willing is an important word there. Neither the buyer nor the seller is being somehow coerced into this trade. Fair value, on the other hand, is used in financial reporting. And I had a great lesson from one of my favorite colleagues in school. He was an accounting professor, and we used to have conversations about valuing executive options. And he was a little bit older than I was, and so he was trying to price options all the way back in the 1900s, let's say. And so he was fascinated by the Black-Scholes-Merton option pricing model and the binomial model to give some kind of a really good estimate of fair value so that we can throw that on the financial statements. And then investment value, of course, is the value that a specific buyer of that investment attaches to it. And this is probably suitable for lots and lots of things, but let me just remind you, we have recently gone through a reading on mergers and acquisitions. So that investment value probably applies mostly there. All right, how about this short LOS? Describe applications of equity valuation. This is probably super simple. Let me go through this as quickly as I can here. All right, this is what we've been talking about, right? And this is what we talk about during lots of the different components of the CFA program, right? Stock selection. Is it undervalued? Is it overvalued? Or does it fall directly? You guys ready for this one? Does it fall directly on the security market line? How about market expectations? A share's market price reflects expectations. Oh, this is really a cool one. And not only market price, but the change in market price. So we can infer some idea about what the market or individual assets are going to do by looking at today's price and yesterday's price and the day before. This is a little bit of a combination of what fundamental and technical analysts do. But think of just momentum. Let me throw that example in here. That's from my optics. You have price goes up and up and up, and everyone thinks, oh man, those expectations, if all those smart people are buying the share of stock, that must mean that there has to be an upward trend. Here we get back to investment value, evaluating corporate events. What effects does a merger or an acquisition? We did those synergies back in that merger and acquisition reading. Rendering fairness opinions, is the value paid for the firm fair? Let me just remind you that the average takeover premium in the acquisition market is around 50%. And so that's really, really a great question. And the only way you can answer that is if you know what those estimated free cash flows of the acquisition really are. And then you can say, yes, it was fair, or maybe it wasn't fair. How about this application? Evaluating business strategies and models. What is the effect of a new strategy on the value of the firm? What does a new strategy mean? So let's take a company like Johnson & Johnson. They have 3 business lines, one of which are medical devices. And so maybe they want to separate one of its medical devices. Maybe they want to separate the knee replacement from all the other replacement models that it has. And maybe it wants to carve that out. Maybe it wants to have some other kind of a spin-off. And so we need to value that particular part of the business or a particular segment. Of course, this is the result of the board of directors changing or adjusting the strategic plan of the corporation. There's an obvious notion there, appraising private businesses there. So what are we going to do? We're either going to estimate their cash flows, or we're going to try to find similar private businesses. And we do this for tax purposes and acquisition purposes and just general valuation purposes. There's another good example, share-based compensation. So you can use any kind of an asset pricing model, but you can also use Black-Scholes-Merton if there are some kind of options in there. And you can even use that for other things to value the debt and the equity portion on the right-hand side of the balance sheet. And then lastly, their communication with analysts and shareholders. Of course, analysts are always asking executives, hey, that knee replacement, how much value does that add to the entire company's stock price? And if the executives shake their head and say, boy, I really don't know, well, that's probably not a good signal. Here we go. Describe questions that should be addressed in conducting an industry and competitive analysis. All right, I love this because here's where we get to do this environmental scan. Let's take a step back and let's scan the whole environment. Now, of course, we're going to start with a big old macroeconomics analysis, but the reading doesn't begin with the macroeconomy. It begins with an industry analysis. So here are the processes, the steps in the process, right? So understanding the business, that makes sense. Forecasting company performance. So we're going to take those financial statements, the existing financial statements, and then we're going to challenge those existing financial statements and make some kind of prediction. So there's a combination of step 1 and step 2. Select an appropriate valuation model. Are we going to use arbitrage pricing theory? Are we going to use value at risk? Are we going to use Black-Scholes-Merton? Or are we going to use the method of the comparables? I mean, however we're going to do this, we're going to base this on the company characteristics and apply the right model to the right scenario. And then, of course, we're humans, right? We're influenced by all sorts of stuff, some of which are fundamental in nature, some of which are behavioral in nature. But sooner or later, we're going to have to combine our science, right? The CFA Institute and this profession is very big on science, right? That's why we do lots and lots of math. and lots of calculus and lots of other stuff, including regression analysis, in which the technical portion of your brain has to be in full gear. But we also have to be an artist. We need to take our brush and we need to go like this and paint and get the right colors and figure all this stuff out, put the pieces together. So notice under that fourth step in the process, using judgment is an important component there. That's the artistry that combines with the science of this valuation process. And then we need to make decisions, right? We make an investment recommendation. We can offer our opinions on events like mergers and acquisitions that are going out there. And then, and this is important, if we're an in-house analyst, we can report these values to the board of directors so that it can adjust its strategic decisions. And then if we're an external analyst, we can report these to our supervisor that says something like, oh, this merger over here is going to stink in the next 5 years. Let's recommend that all of our clients either sell those shares of stock or short them. So it applies to both internal and external concluding remarks. All right, let's look at some of these questions here. What is the attractiveness of the industries? What is the relative competitive position? And how well has the company executed its strategy? All right, so look at the diamond points above. Which aspects of the business have the greatest opportunities and challenges? I tell my students this all the time. I've said this to you guys before in the recordings. I don't ask my students to do a SWOT analysis because they do it in their other business classes. But SWOT analysis, strengths, weaknesses, opportunities, and threats, this is a really good way to scan the environment. So let's go through these questions individually. What is the attractiveness of the industry in which the company operates? Well, of course, the first step is to take a look at the company's profitability inside of this industry and then look at the industry's profitability. And this depends on things like trends and industry structure. Of course, we go back to 1979, Michael Porter from Harvard introduced these 5 forces. Now, even though Porter's PhD is in economics, these 5 forces have been applied to management and marketing and economics and all sorts of business disciplines. And so this is probably why the Institute is including it in this reading, because A, it's really cool stuff and it's super helpful in this environmental scan, but it has applications across all kinds of business lines. So look at that blue arrow point. Michael Porter's 5 forces are widely used in understanding industry structure from, what did I just say, a marketing standpoint, a management standpoint, a leadership standpoint, from a supply standpoint, et cetera, et cetera. So here we go. Long-term profitability in any industry is affected by these 5 forces. So threat of new entrants, threat of substitutes, rivalry among existing competitors, and then the bargaining power of buyers and suppliers. So of course, back in 1979, bargaining power of buyers, bargaining power of suppliers, that was kind of a relatively new and innovative concept. Of course, now, decades later, we talk at length about the supply chain. So this is exactly, those two right there are the supply chain. Remember, we got the supply over this side, and then we're supplying over on that side, however that works. Now, here's the grade exam question. Two parts of this grade exam question. To have candidates identify which one of those 5 given a paragraph. But then the second part of this is that Porter emphasizes that these are permanent factors, right? These will always and everywhere affect an industry's profitability and therefore will impact individual companies inside of that profitability. Don't confuse those with kind of temporary or secondary factors that might influence profitability in the short term. Maybe things like government interventions, maybe things like advances in technologies, maybe things like growth rates inside of the industry. And so those things are temporary. Even though they do have an impact, these things are permanent. How about that second question? How about relative competitive position? We need to compare this to the level and trend of the company's market share. So this is a beautiful marriage between what we're studying here, finance, and marketing. You know, the marketing people, my marketing colleagues, they always talk about capturing market share. And I always respond by saying, well, of course, you can't capture market share unless you invest in positive net present value projects. And so we have a little friendly battle about what's more important and how you capture that market share. But nevertheless, that's the goal here. So relative competitive position. And so this has everything, almost everything to do with branding, right? The company's value should be high enough that it can create and it sustain an advantage. So we brand these product lines. I use the example of Hershey's chocolate all the time, right? You bite into a Hershey chocolate bar, you know what it's going to taste like. But if you bite into Jim's chocolate bar, you have no idea where Jim got his ingredients. You don't have any idea if Jim's taste is going to be consistent over time. All those factors. So branding is super important as it relates to the relative competitive position. All right, so what do we have down there, that last illustration? The corporate strategies to achieve above average performance include being a lowest cost producer, differentiating our product, and maybe our customers can assign a different value. And then we're either going to focus on one or the other, cost or differentiation. And then how well has the company executed its strategy? There's a financial statement over there from Nike. We used that back in the when we talked about financial reporting. And so what do we know? I mean, you can look at the financial statements and you can evaluate different segments. You can evaluate different growth rates. You can combine those 5 forces and evaluate and extract data from those financial reports to evaluate a company's performance against its strategic objectives. Sources of information. This is an obvious one. You probably don't need me to read these to you. You get information from all different types of sources, including social media. And then, of course, what you need to do is make certain that the information that you got is accurate and it's complete and all those good things that we talked about. Remember, we had that entire reading on the quality of earnings. How accurately does the reported performance reflect economic reality? And then the second part of this, and this was super important back in that earlier reading, is that if a company has earnings that are above the earnings of its chief competition inside of the industry, the next question is, was that a one-timer, or is that something that is, boy, look at those words, I love those words, sustainable or persistent? And that's what we did in that previous reading, is to determine the process of figuring out whether or not those earnings are sustainable, or if they're just, can I use a music example? You know how when you're listening to rock and roll music on the radio, the DJ will say, hey, here's a song from a one-hit wonder. I always wanted to be a one-hit wonder because I always wanted to be a rock and roll superstar. Anyway, all right, so quality of earnings. Here's some examples. We probably did this in a previous reading. Recognizing revenue too early, of course, recognizing too much or too little reserves, using off-balance sheet financing. Oh boy, we like that with those special purpose vehicles. And then look at that last one there. That's almost comical, using a bank overdraft as an operating cash flow. Well, we'll use this analogy. My children, they use their own bank overdrafts as an operating cash flow because their debit cards are tied to my debit cards, so they don't have any care what we call it. But of course, a business can't do that. So that's probably the good exam questions over in the right-hand column, those potential consequences or interpretations. And so those should be obvious notions there. All right, I did say this earlier, right? Absolute valuation models versus relative valuation models, and each has its own advantages and disadvantages. So let's just quickly go through some of these circle points. So an absolute value model, we're going to estimate intrinsic value. These are present value models. So look at the lone circle points down at the bottom. Dividend discount model, we owe that all to Myron Gordon back in the 1950s. Free cash flow to equity, we owe all of that to Modigliani and Miller from 1958. But remember in our capital structure discussion, Modigliani and Miller, they used net operating income because they hadn't quite yet invented this concept of free cash flow. They knew what it was, of course, but it hadn't been termed. And then we can also use residual income models or asset-based valuation models. Now, the relative valuation models, this is always known as the method of the comparables. So look at the multiples down there, price earnings, price cash flow, and then the enterprise multiples. We do the same kinds of things. So we put something in the numerator that we attach as some kind of a value, whether it's asset price or an enterprise value, and then we divide by stuff that we think that's important on the financial statements, like cash flows or book value or earnings per share. Now, the important part of those relative valuation models, look at the second double circle point, assumes that similar assets have similar values. So once again, I'm going to emphasize this. This is super important, that when you use these relative valuation models, you need to compute the price or enterprise multiples for firms that are similar. And similar can be of size and similar can be of risk level, but that needs to be identified before the model is used. How about this interesting one? Describes some of the parts valuation and the conglomerate discounts. You remember when we talked about mergers and acquisitions, we said, okay, we have a company that's worth 1, and we have another company over here that's worth 1, and we add those two companies together, we merge them, and all of a sudden their combined value is 3. Well, suppose you continue to do that. You add 1 and you add 1, you add 1, and all of a sudden you have 10 individual companies that are now formed into this one company, and their value, oh boy, what would we think their value? We would think their value would be, let's say, 13 or 14, right? 10 companies each worth 1. But maybe this company, this conglomerate, has gotten too big and too unwieldy that there's a loss in value. So this sum of the parts valuation simply means that we take the 1 and the 1 and the 1 and we value each of them, and then we compare them to the value of the conglomerate. And so if the sum of those parts exceeds, this is almost like anti-synergy. I'm not sure that's a word, but I think I can convey what that means so that you could probably break up or have an individual spin-off or an equity carve-out or something there. And look at that last arrow point. Unlocked from a restructuring like a spin-off, a split-off, or an equity carve-out. We talked about those at length back in that merger reading. So make sure you understand this conglomerate discount. Let me read this to you. A discount applied to the stock of a company operating in multiple unrelated businesses relative to that of companies with narrower focuses. So we got this huge company here, and it has a 1, right? A value of 1. And this one company is competing against these companies over here, and this is all they do. But this company is a silo in all of this stuff over here. Of course, there are lots and lots of examples of companies that are conglomerates here in the U.S. I think General Electric might have been like the first gigantic conglomerate. But then isn't BH one of those big ones? Hundreds of thousands of dollars in stock price. All right, reasons for a conglomerate discount. Lack of focus, that makes sense. Inefficiencies in capital allocation. So think of it this way. You have, what did I say? We have 10 individual companies that make up a conglomerate. So think of these 10 individual companies as silos. And each one of those silos is operating in its own maximize shareholder wealth kind of a model. But there has to be somebody here above, like maybe it's the chief operating officer, maybe it's the chief risk officer that's looking at correlations and copulas between and among all of those different silos. And if it's not done in an efficient manner, look at that second point there, inefficiencies in capital allocations across all of those divisions. I think that's what the reading use. I always think of them as silos. So if there's inefficient capital allocation, there's no way it's maximizing firm value. How about factors that are endogenous to each one of these silos? So we got this silo over here that's going to make an acquisition. We have this silo, and then maybe the company here is going to have an acquisition over there. Unrelated industries, this is probably going to lead to poor performance. But that's an interesting example of what comes first, the chicken or the egg. Do the making acquisitions in unrelated industries lead to poor performance, or does the poor performance lead to making acquisitions? I don't know. That's an empirical issue beyond the LOS. And then, of course, research measurement errors. How about broad criteria for choosing an appropriate approach? All right, so what are these model selection and interpretations? All right, consistent with characteristics of the company. That makes perfect sense. Appropriate given availability and the quality, right? Remember, we need to have high quality of data, and it's consistent with the purpose of the valuation. All right, so let's go through each one of these kind of quickly. Relative valuation is probably appropriate for a bank because that bank does all the same kinds of things, but it might be less appropriate for a service-based industry because that service-based probably is trying to differentiate and may not have that population or a sample of companies that are similar to it. Yeah, how about availability and quality of data? I don't like this arrow point there, the orange one. Cannot use a dividend discount model on a company that has never paid dividends. Of course you can't. However, it's easy just to substitute free cash flow in there. And then a problem with these negative PEs if you have earnings that are negative. I don't really have a good answer for that one there. There we go. Controlling equity position, use free cash flow to equity rather than the dividend discount model, which of course is value for all of the flows, but that free cash flow to equity just flows right to shareholders. And that takes us through this relatively short slide deck and relatively short reading. Let me just give you a summary here quickly. This is the first reading, and I think there are 8 total readings in this topic. And so this really is kind of a way to set the stage of stuff that we're going to do over the next 7 or so slide decks and readings. So I'll probably make comments in those future readings and recordings that sound something like, hey, you remember that first recording we did? This is more specifically what the Institute was talking about.